was looking at the sort of moment-to-moment performance of silver relative to gold. The last day or two, it's been a little bit different, admittedly, but in recent days, I'm going to hang around until it comes back to 72 or something like that.
Why would there be a pop again this time? Like, what's different this time?
And that would mark the beginning of a really big move above $50 all the way up to 120. That is really the power of a squeeze. And
Sounds like a price forecast to me. I'm definitely hearing triple-digit silver by the end of 2026. Double its price, that's solidly in the triple-digit category.
Absolutely.
Let's call it, what, $150, $160 silver.
We understand the big picture, and we know that this is mispriced. Therefore, this is something I'm going to hold until it is no longer mispriced. Silver is still in supply deficit, big time. Now that China has decided to stop helping us out with a shortage of silver, this is a market which has just gone very, very quiet. By the end of June, we'll start seeing this running. The industrialists will be holding out their hands for any silver that they can get.
So, Alasdair, as you've articulated, we have supply issues exacerbated by this sulfuric acid bottleneck, which will show up sooner or later. We've got a growing industrial demand. We're starting to see some changes in the COMEX. So what's the inflection point here? You're saying the markets aren't showing this. When do you expect the markets to show this? When does the silver explode, as the headline of your article said? What's the inflection point?
Well, I mean, the reason I used that headline was I was looking at the sort of moment-to-moment performance of silver relative to gold. And in recent days, now, the last day or two, it's been a little bit different, admittedly, but in recent days, we've had situations where gold has maybe gone down by 0.25% or something like that, and silver is up 1%. Normally the relationship is that if gold's down 0.25%, silver will be down 0.5%. And it sort of rather suggests that in this market, which has just been moving sideways now for several weeks, on the dips, there are people accumulating silver. If you look, for example, at COMEX, now we've been talking about COMEX, the open interest has actually recovered. It's still incredibly low, but it's recovered something like 3,000 or 4,000 contracts. Not a lot, but each contract is worth 5,000 ounces, and we're in a market, as we discussed before, where the shorts are really hurting. So this could kick off again. The problem is we don't know when it's going to happen until it happens. I mean, who would have thought that on October the 9th, lease rates would suddenly jump to 40%, and that would mark the beginning of a really big move above $50 all the way up to 120. That is really the power of a squeeze. And
markets are acting calm, but calm is exactly how positioning shifts before price catches attention. As Alasdair Macleod points out here, silver rising on day's gold weakens matters more than the headline price, because relative strength often appears before broad participation arrives. Open interest recovering while short pressure remains elevated suggests institutions may be rebuilding exposure quietly, rather than chasing momentum publicly. For long-term investors, the danger is assuming price confirms fundamentals instead of recognizing accumulation phases first. Next, Alasdair Macleod exposes the specific positioning tactic in COMEX, reporting that hides true institutional demand.
I don't think anybody would have expected that at the time. I mean, okay, there are a number of technical analysts running around saying, well, this is looking good, whatever. But other than that, I think realistically, there's nobody really expected that run. Well, I mean, when it sort of really got going, then we all got terribly excited. But these things come out of the blue, Michelle, and I think this is going to be no different. The problem, I think, for investors is that if they try and play this one, they'll probably get it very, very wrong. I'm going to hang around until it comes back to 72 or something like that. Okay, you may be right, but there's a bloody good chance you'll miss the boat. And I think the way to play this is to say, okay, we understand the big picture and we know that this is mispriced. Therefore, this is something I'm going to hold until it is no longer mispriced. And I think that's the sensible way to do it. Don't try and trade it too, if you like, sort of too precisely. That, I think, always leads to tears. And there are very, very few traders who really do make money out of precious metals, if you like, on that on that basis.
Okay, but for silver investors, they've heard variations of this bullish thesis for decades. Structural deficits, manipulation, industrial demand, constrained supply. Silver for the most part has disappointed investors. I mean, we did have a dramatic run up, and some say, okay, that was it, that was the moment. Now it's accurately showing the fundamental level that silver should be at, factoring in inflation and other things as well.
If this cycle turns while investors wait for perfect entry prices, missing the move becomes more expensive than being early. According to Alasdair Macleod, precious metals are one of the few markets where over-precision punishes more people than bad analysis. The deeper issue is that retail investors are trained to optimize entries, while institutions accumulate across time and liquidity windows. Wealth preservation is usually less about timing brilliance and more about avoiding forced decisions under volatility. Next, Alasdair Macleod reveals what the Fed's own meeting notes expose about gold, and it contradicts their public narrative entirely.
Why would there be a pop again this time? Like, what's different this time?
Well,
when there's been all of this constant, I mean, we did get a run up, that's for sure. But then someone's saying, okay, well, that was expected because that's just structurally repricing to reflect all of the things that we've mentioned, including inflation, and that's already accounted for. So,
well, sure, but I would point out again, going back to where we started with this. If you look at if you like, the subordinate industrial metals like copper, then, why is copper doubled and silver not? Silver actually, while copper has doubled, I mean, it's doubled more or less. No, it hasn't quite doubled, but it's hitting new high ground. I think it's doubled over the last year. Hitting new high ground, and silver is still languishing at around about the $75 level. It just doesn't make any sense. The other answer, I think, to the very valid point that you raise is that silver is still in supply deficit, big time. And now that China has decided to stop helping us out with a shortage of silver, this is real. It really is.
Okay, so our viewers are not going to forgive me if I don't ask you. I know you don't like to give price forecasts, but where do you see silver ending 2026?
Well, I don't give. You're right. Never ever give price forecasts. I've been a stockbroker long enough to know that you stick your neck out.
Copper made new highs while silver stalled, and official explanations act like that divergence is normal. What Alasdair Macleod is highlighting is not simply supply deficit, but a pricing framework that still treats silver as optional industrial demand instead of strategic demand. Markets frequently anchor to old narratives long after fundamentals change. Investors should pay attention whenever two assets tied to similar macro forces stop behaving similarly, because repricing rarely arrives politely. Next, Alasdair Macleod unravels why their public narrative about supply requires three contradictions to work.
But then if you're right, I sing your praises.
It's a guess. Michelle,
how about a time estimate, like within this range you expect silver to be at a year from now?
I think it's going to start running. I think probably within a month. No, don't hold me to it, but I think it's quite likely to. The reason I say this is that this is a market which has just gone very, very quiet. It's a stalemate, if you like, and that will be resolved. These stalemates don't last for very, very long. So, perhaps, by the end of June, we'll start seeing this running. I think there is another problem that we're going to run through, and that is that markets are wildly, I'm talking about equity markets, are wildly overvalued relative to bonds. And when bond yields start rising, as they are beginning to do, and particularly when you see the US 10-year note going through the 5% level, or looking like it's going to go through the 5% yield level upwards, then I think you are on the verge of an equity market crash. That is going to, I think, create all sorts of unexpected events. Last time when we had the problem back in 2007, 2008. It knocked gold down from around about $1,000 down to $680 before it then went on to $1,920. But this time, nobody owns the gold stuff. What you will see is the people making markets trying to mark things down, but at the same time, the central banks will be in there buying it because they will look through this. They're not influenced by, oh my God, I'm making a loss sort of thing.
This happened before prior dislocations too. Quiet markets, rising yields, and confidence right before liquidity disappears. Alasdair Macleod's argument suggests the real signal is not silver itself, but stress building between bonds, equities, and hard assets at the same time. Central banks do not wait for headlines. They position through them. For investors protecting purchasing power, the question is not whether volatility comes, but whether portfolio assumptions survive it. Next, Alasdair Macleod walks through the exact timeline when institutional money shifted from bonds to commodities, and why retail is always 18 months behind.
I think that also the industrialists will be holding out their hands for any silver that they can get. So any of that disruption, I think, is likely to be a lot less than it was during the great financial crisis. But apart from that, it looks to me as if silver, being an industrial metal, being in about its 7th year of supply deficit, I think that that's got huge potential on a relatively short-term basis. So by the end of this year, I wouldn't be surprised to see it at least double this current level, maybe even more.
That sounds like a price forecast to me. I'm definitely hearing triple-digit silver by the end of 2026. Double its price, that's solidly in the triple-digit category.
Absolutely. You've tempted me.
All right. I will take that, definitely. So double from here. Let's call it, what, $150, $160 silver. And back to what we're seeing with the demand for physical delivery. We were talking about the COMEX and we were talking about contracts. And from my understanding, more and more contracts are now resolving with physical delivery, not just closing out on the sort of paper profits or losses. We've also seen an influx of physical silver exchanges, like we saw the ABAX exchange open in Singapore recently, which does deal specifically with physical silver being delivered to various vaults in Singapore to be used for industrial uses. So let's focus on the industrial side of the equation, because back to your thesis that silver needs to explode higher from here, we've long said solar, electrification, military applications, there are going to be a lot of missile resources that have been depleted in this conflict and the one in Ukraine, AI infrastructure, cell phones, data centers. Talk us through that side of the equation and how the demand is also accelerating here. Do you think that the market is still underestimating the demand for industrial silver?
Yeah, I believe it is. I mean, I'll just give you one aspect of this. India has been opening coal-driven power stations in enormous numbers. 60 or so of these things being opened and so on. And so there is a big carbon footprint. And so President Modi decides to offset this by encouraging the major Indian conglomerates like Reliance Industries to invest in photovoltaic cell production. And indeed they have. What they've done is they've rushed out and they've spent billions of dollars equivalent on manufacturing facilities and producing their own enormous solar farm and all the rest of it.
Industrial users don't wait for headlines. They secure supply, while retail debates whether the story is real. This is where Alasdair Macleod's thesis shifts from speculation toward inventory behavior, because persistent deficits only matter when buyers stop assuming tomorrow's supply exists. Institutions rarely announce accumulation until prices already moved. For investors protecting purchasing power, the bigger risk may not be being wrong on silver. It may be underestimating how quickly access changes once procurement replaces price discovery. Next, Alasdair Macleod exposes the one metric central banks are watching that proves they expect a devaluation cycle, not deflation.
Well, the problem is, where do they get the silver from? I mean, if they go along to the refiners say back at the queue. And I think that quite a lot of the standing for delivery that we're seeing is really rather desperate attempts by Indians and other national, businesses, if you like, around Asia, trying to sort of get involved in this market. And in the case of India, of course, there are government subsidies being offered for conglomerates going into this business. So that's an example, I think, of the sort of thing that's happening. Now, their demand for silver is going to continue apace. And the other thing is that one of the big sources of demand, of course, growing demand, has been electric vehicles. And now that Hormuz is closed, guess what? Tesla's sales are going through the roof. People are literally, because of the fear of higher fuel prices and all the rest of it, it's actually been a boost to EV sales. EVs need silver. And you also mentioned, the missile situation. Certainly my very good information in the UK is that we've just about run out of ordnance. And that is, because basically it's all being consumed over Ukraine. And now, of course, we've also got the Israeli situation. So America's got very little ordnance. NATO as a whole has got very little. We're all very, very short of ordnance. And I guess Israel is as well. So it means that an awful lot of missile technology has got to be replaced at an accelerating rate. It's hardly surprising that America puts silver on the critical minerals list.
Governments keep calling inflation temporary, while subsidizing industries that intensify demand for finite inputs. Alasdair Macleod notes that once strategic demand enters a commodity market, price can stop behaving like a clean supply and demand equation and start behaving like procurement competition. That is the part usually omitted from mainstream coverage. Industrial policy and security priorities can crowd out normal market signals. For wealth preservation investors, shortages matter less than who gets served first when supply tightens. Next, Alasdair Macleod points out the specific positioning tactic in COMEX, reporting that hides true institutional demand.
Where is it going to get its silver from? So you've got that. And another thing, I think, is that these AI data centers, they consume huge amounts of silver. A really big data center will take a third of a ton of silver in terms of all the sort of computer power and all the rest of it, and all the cabling and all that sort of stuff. A third of a ton of silver in one of these things, and we're all wanting to build these data centers. It is quite remarkable how we've got these demand factors hitting silver. I really do think that it should be priced as an industrial metal. It's markets that, through habit, I think, are pricing silver purely as a monetary metal. But the monetary demand is not all that great. I know there has been an accumulation of investment, if you like. If you look at ETFs, I think there's something like a billion ounces or 1.3 billion ounces in global ETFs, silver ETFs. And but that's not growing much actually from that level. And interestingly, with all the hiatus of a price going up to $120 and then falling down to $61 and then bouncing back up to 75, the decline in that ETF, the total ETF total, is actually very, very minimal. It's extraordinary. This should be priced as an industrial metal. That is where the demand is at the moment. Now, that's not to say that the monetary aspect will come back in the future. I fully expect it to do so. I think when it does, it will be because gold is going better.
Markets celebrated the AI build-out, but almost nobody asked what inputs become scarce when digital infrastructure goes physical. What Alasdair Macleod is highlighting is a quiet transition where silver demand may increasingly come from industrial necessity rather than investor enthusiasm. That distinction matters because industrial buyers tend to absorb supply regardless of sentiment. Investors focused only on ETF flows may miss the possibility that the real tightening appears off screen before it appears in price. Next, Alasdair Macleod reveals what the Fed's own meeting notes expose about gold, and it contradicts their public narrative entirely.
And people begin to think silver is a cheap way into gold. I mean, to buy something at $90 or $80 or whatever is a far more attractive proposition to the masses than, let's say, paying $5,000, if you see what I mean. So, and not only that, but, the relationship very much has been that if gold goes up 1%, silver goes up 2%. So, this is a sort of the ultimate speculative play, if you like, with respect to gold. So that is yet to come in. And unfortunately, I think it's likely to clash with all the sort of environmental and other demands for silver. And also the fact that China is no longer supplying the rest of the world with her surplus. So,
yeah. Nor with China's sulfuric acid.
Markets call silver speculative, yet they treat the metal that powers industry and tracks monetary stress as an afterthought. Alasdair Macleod's argument suggests that affordability itself becomes a demand catalyst once gold moves beyond retail comfort zones. That creates a contradiction policymakers rarely discuss. Financial demand can arrive at the same moment industrial supply becomes less flexible. For long-term investors, the risk is assuming yesterday's gold-silver relationship survives a structurally different market.